The live intraday price for Dell Technologies stock, trading under the ticker DELL on the NYSE, is currently $124.91, representing a sharp decline of $8.85 or 6.62% in today's session, as of the time of this reading. The immediate headline drawing all the attention today is not just the general market weakness, but a dramatic double downgrade from a major investment bank that has sent a tremor through the entire hardware sector. Most investors are naturally focusing on the cut to underweight and the reduced price target, which dropped substantially from $144 to a new bearish $110. This is the simple expectation. A bad analyst note equals a big drop. However, the unexpected, more profound insight here lies in the reasoning behind the downgrade. It's not a simple demand issue, but a very specific and potentially transient problem with component cost inflation, specifically the surging cost of memory drives, a core piece of the server and PC puzzle. The market narrative, which has fueled Dell's incredible run to its recent one-year high of $167.94, was all about AI server momentum, the idea that Dell is a primary indispensable partner, much like NVIDIA stock is for the chips, but for the entire infrastructure package. The common belief is that the immense demand and high average selling price of these specialized AI servers would simply power through any traditional PC or legacy server weakness. The reality being forced upon the market today is that even the mighty tailwind of AI demand is not immune to the crushing pressure of gross margin contraction. When the cost of core components, such as high-performance memory necessary for these AI builds, rises faster than Dell can adjust its pricing or mitigate through scale, the profit picture gets painted in a much darker shade. It forces investors to reckon with the unglamorous but critical reality of supply chain economics, a factor that is often overlooked when the hype surrounding a technology like artificial intelligence is at its peak. This is why you are seeing this significant price action and elevated trading volume today, with over 5.5 million shares exchanged already, which is substantial for a pre-market and early trading session movement. Breaking down the price movement over the last few weeks highlights this tension between expectation and reality perfectly. Dell stock has been in a pronounced free fall since that November 3rd high, now marking its 12th loss in the last 14 trading sessions, pushing it to levels not seen since early September. This is less about a sudden loss of confidence and more about a systematic reevaluation of the profitability outlook. The initial rally was driven by the expectation of massive revenue and backlog from AI server sales, including a recent, very public $5.8 billion AI server contract announcement. The reality is that the market is now fixated on the fact that those high-revenue, low-margin AI server sales might actually dilute the company's overall gross margin in the short term, especially when coupled with memory cost spikes. The analyst note for Morgan Stanley explicitly cut fiscal year 2027 gross and operating margin estimates by about 150 to 220 basis points, which is a big number that directly impacts future earnings per share projections. This margin pressure is the core problem, overshadowing the unquestionable strength in top-line demand. Looking at the technical landscape for Dell stock, the current sell-off has driven the stock's 14-day Relative Strength Index, or RSI, down to a deeply oversold level, hovering around 14. This is a technical indicator that often suggests the selling pressure is extreme and a short-term rebound or consolidation might be due, but it should never be relied upon in isolation, especially when a strong fundamental catalyst like a major analyst downgrade is driving the bus. Interestingly, the 160-day moving average is lurking right around today's low, which could provide a temporary technical support level, but the heavy volume suggests a substantial shift in institutional sentiment. Furthermore, we've seen significant insider selling over the past few months, totaling hundreds of millions of dollars in stock sales from key executives and large holders like Michael Dell and Silver Lake. While insider selling can often be for planned financial reasons, the sheer scale of the sales, particularly in the wake of the stock's massive prior gains, does not exactly inspire overwhelming confidence and certainly adds to the negative sentiment that is now compounded by the external analyst view. The business of Dell Technologies itself is a complex mix of old-school enterprise hardware and bleeding-edge computing solutions. Its operation is generally segmented into two main groups: the Client Solutions Group, CSG, which handles PCs, workstations, and peripherals for commercial and consumer markets, and the Infrastructure Solutions Group, ISG, which is the powerhouse for servers, storage, and networking equipment, and is the key to the current AI server thesis. The expectation for a long time was that the ISG, fueled by the necessity of on-premises private and hybrid cloud infrastructure for AI workloads, would carry the weight of the traditional, slower-growth PC business. This ISG segment has indeed been stellar, with expectations of mid to high 20s growth. Dell's model is deeply intertwined with the enterprise and government sectors, relying on a vast network of channel partners to fulfill its sales. Unlike consumer-focused companies like Apple stock, which is vertically integrated and driven by direct-to-consumer sales, Dell is a B2B infrastructure specialist. Its strength lies in its ecosystem collaborations, such as its deepening partnerships with NVIDIA to deliver pre-packaged AI data platforms and its robust service and financing arms. For an individual investor utilizing an online investment platform like Fidelity or even a commission-free trading application like Robinhood, Dell often represents a play on enterprise-level technology spending rather than a consumer gadget story. When we look beyond the AI narrative, the traditional parts of the business are still struggling. Weakness in general enterprise server demand, separate from the highly specialized AI server segment, and continued sluggishness in the PC market create a heavy counterweight. Dell's overall financial health, as suggested by an Altman Z-score in the gray area of financial stress, highlights the balance sheet challenges, including a high debt-to-equity ratio and a current ratio below 1, indicating potential liquidity concerns. This means the company has less financial wiggle room to absorb sustained margin pressure compared to its more cash-rich peers. This is an important consideration for anyone engaging in self-investing and comparing Dell to other infrastructure plays. Many analysts still maintain a strong buy or buy rating on the stock, with an average price target that forecasts a significant upside from today's depressed levels. This split in analyst opinion, the current underweight versus the consensus strong buy, perfectly encapsulates the tension between the immediate but painful reality of margin compression and the long-term powerful expectation of AI-driven revenue growth. The bullish analysts, such as those at J.P. Morgan, are betting on the sheer volume and revenue lift from new AI server orders will more than offset the temporary margin drag and memory cost inflation, placing the stock on a positive catalyst watch ahead of its upcoming earnings report on November 25th. This is the moment of truth for the Dell investment thesis. Now let's consider the forward-looking outlook and the potential catalysts that will determine whether the stock can reclaim its momentum. The immediate and most pressing catalyst is the upcoming earnings report. The expectation here is that the report will need to do more than just deliver on top-line revenue. It needs to provide a credible, concrete path to stabilizing or expanding margins in the face of these cost headwinds. The guidance for the January quarter will be the critical element, and J.P. Morgan expects revenue of $29.4 billion, well above consensus, which is a powerful counter-expectation to the current price drop. If Dell's management can articulate how they are mitigating component cost inflation and how the mix of AI server sales will eventually become more profitable as the company transitions to higher-value enterprise solutions, the stock could see a significant snapback, fueled by the fact that the stock is now technically oversold. Conversely, any softness in that margin guidance or any hint that the AI server backlog is taking longer than anticipated to convert into high-quality, high-margin profit could validate the bearish downgrade and send the stock testing its one-year moving average support levels. For investors managing their portfolios through platforms like Schwab Intelligent Portfolios or utilize investment help resources, the Dell story is a case study in sector-specific volatility. The risks are clear. Continued high interest rates could dampen enterprise capital expenditure on traditional IT, the PC market remains a structural headwind, and any slowdown in the adoption of AI could remove the single largest tailwind. The opportunities, however, remain centered on the fact that Dell is a fundamental pick-and-shovel play on enterprise AI infrastructure. The long-term expectation is for massive, persistent demand for on-premises AI systems, which will require not just chips, but the full stack of integrated hardware that Dell provides. The company has explicitly doubled its AI infrastructure investment forecast to $400 billion by 2025, which, if realized, provides substantial revenue visibility. The growth in specialized rack volumes for AI is expected to double in 2026, which speaks to a durable multi